Welcome back. It's still the midweek edition of Business Morning on Channels Television, and we're broadcasting live from Lagos, Nigeria. Well, today on the program, our conversation is going to be centered around the latest decision from the Monetary Policy Committee. Well, we know that they had a two-day meeting on Monday and on Tuesday to decide on whether to take a different stance on exchange rates, on stabilizing the exchange rate and other macroeconomic measures that should be put in place to actually protect the economy. Well, I'm being joined on the program now by the Managing Director and Chief Executive Officer of Financial Derivatives Company Limited, Ms. Makarwani. Thank you so much for joining us this morning.
Good morning.
Well, were you surprised with the decision by the Monetary Policy Committee?
No, nobody was surprised. The market was not surprised. Everybody expected it. And it just shows the level of maturity on the side of the central bank and also on the side of the market.
Now, the committee also decided to maintain the cash reserve requirement on public sector deposits at 50%. But in light of recent developments in the money market, is this the right stance to take?
I think so. Basically, in the first place, you cannot fund the books of banks with volatile government deposits. The definition of a central bank in 001 economics is the central bank is the government's bank and also the banker's bank. Therefore, there's no reason why government funds should be in the banking system in the first place. If you were to remove it precipitously, it will lead to a problem. So I think what we are seeing is a gradual withdrawal of government money from the banking system. So the banking system finds a flaw of its liquidity and uses that to fund its transactions.
Now, one of the things that the committee actually noted was that there was continued dependence of the banking sector on monetized oil revenues for its liquidity. What does this mean?
That means government money.
Okay.
Oil revenues are government monies which come back into the system. So you convert it into Naira, which means monetization. Okay. And that money is volatile because it's only transient in the sense that, you know, you go to Abuja, the FAC comes in, you share it around, then you spend it, and it goes all the way back. In any case, even the government monies that are going to be kept in the central bank we used to pay contractors. The contractors are customers of the banks. So invariably, at the end of the day, the money still gets back to the banking system. But it is transient money. It's what we call volatile deposits. They're not reliable. And that cannot be the basis on which you fund a loan book, especially if you're funding term loans on funding some trade finance transactions. And when you look at it, it is actually rent, in the sense that the government deposits money at maybe 5, 6, 8, 9, 10%, and the same banks lend back to the government money at 15, 16, 20%. So it is a subsidy. And the subsidy in the banking system are in three levels. One, the exchange rate, which is subsidized, the interest rate, which is also subsidized, and then benefiting from the petroleum subsidy. So when you take away all those subsidies, then the banking system becomes more efficient. And many banks are doing that already, become much more efficient and looking at how to improve the payment and settlement system, improve the service to the customers, and actually serve as a catalyst for growth in the economy. Okay,
so now, is this not going to be like a form of risk now for the banks, because we're having most of this money taken away from them? Doesn't this put them at risk?
No, not necessarily. First and foremost, the banks have capital adequacy ratios which are in excess of the minimum, so the banks are adequately capitalized. They report liquidity ratios which are infinitely higher. They have AMCON bonds, some of them which have been repoed. So I don't think there's a significant risk. But in any case, there's no business that doesn't have a risk. And the reason why there are supervisory agencies and regulatory agencies to ensure that the level of risk is not out of proportion to the level of capital which they have. So I don't think that's a major issue.
What about the bond market? Because we've seen that the latest developments have actually affected all markets across the board. Now, what about the bond market?
Well, there's an inverse relationship between the price of bonds and interest rates. When interest rates go up or increase, you find the asset values actually come down. So the real estate prices will come down, bond prices will come down, and stock prices will come down. You heard the stock market analysts talking about it just now. But that's natural. Now, what you have to ask yourself, what is the objective of this exercise? The objective of the exercise is that the Central Bank of Nigeria and the Monetary Policy Committee is charged with maintaining financial stability in the context of accelerated and sustainable growth. Now, what has happened is that we saw growth decline in the second quarter.
In the second quarter.
As a matter of fact, since 2012, we've had growth below 7%. We had 7% average growth in the last 5 years, but now we've come down for a number of reasons, some of it global, some of it domestic, including the withdrawal of subsidies and how it was badly managed. However, in any case, the objective of the central bank is to use monetary policy tools to maintain low rate of inflation. The inflation target is called single digit, which is meaningless. You have to have a target which is a specific number. Now, the fact that you've had inflation at 8.2% is as a result of the successful implementation of certain monetary. But what is the price that the economy is paying for it? The price the economy is paying for it is that, one, you are having a reduction in a slowdown in growth. You are having depletion of your external reserves, and you are also facing a high unemployment, right? That's in the short run. But also, why is there low inflation? Because money supply growth, which the target is 15%, was actually minus 3%. So you have that. Okay, if you increase money supply, you also increase the risk of inflation. So the question is, what is your objective? The objective is to maintain macroeconomic stability. What is the framework? The framework is inflation targeting. What is the anchor you're going to use to achieve this? The anchor is either the interest rate, what we call the nominal anchor is the interest rate, or the nominal anchor is the exchange rate. So the inflation now and exchange rate are more important than the interest rate. That's what the CBN is actually saying. That is in the short run. In the long run, then? In the long run, we're all dead anyway. So that's what Keynes said. But in the long run, you have to achieve increase in productivity, increased growth, high employment, that is reversal of the unemployment, and therefore, because what we call the misery index, the level of miserableness of the people, is inflation plus unemployment. So when you have unemployment of about 30% plus inflation of 8%, you have a 38% misery index. The misery index has to reduce in the run-up to an election, okay? Or else all bets are off, okay? Right. So you need to, while you bring down inflation, you need to address the question of unemployment. Unemployment only comes about by increase in investment. Okay, so now that we see an increased attention being paid to a particular sector, agriculture, yes, are we going to see this miserable index reduce? No. The time between when you plant a tree and get the results, right? A palm tree or something, even maize, yes, the steps are, there's a lot of nice rhetoric on agriculture. There's been some initiatives. The idea is that we can do some things, but it's going to take a long time for it to mature. The lowest hanging fruit is the power sector reform. But power sector reform means that the assets are just being transferred. The guys are going to have to mobilize and put money into these assets which they've acquired. They have to put know-how, and they have to learn. So it will take another 2-3 years before you begin to see meaningful transformation of power. So there are no short-term fixes. There are no silver bullet to solve the Nigerian economic problem. In the meantime, the price of oil is coming down. In the meantime, reserves have depleted to $45.8 billion, right? So there are pressures. The economy is vulnerable to exogenous shocks. That is why the central bank took this position, first as a defensive strategic measure to defend the economy. Yeah, so I was just going to, because we've seen that in the last couple of weeks, the Naira has actually been depreciating. Appreciating now. Well, it's relative actually, because it's still going up and down like a yo-yo. Volatile, yeah. So I will know that the CBN has tried as much as possible to intervene to keep pressure off the local currency, but how far can the CBN actually go in saving Naira? You see, nobody has ever won a currency war. Nobody in the world has ever. Even the UK tried it, the US tried it. Don't even waste your time. A currency will find its fair and true value over time. It's the most perfect of markets, and it's the most vulnerable market to speculative attacks. In the sense that it's like petrol shortage. The moment people believe that if you see two people standing in front of a gas station with a jerry can, immediately your mind goes to there must be shortage. Even if you have 3/4 of your tank, you go and top up. And that becomes a self-fulfilling prophecy. The reality is that people are speculating against the Naira. The more you try to defend it and all of that, the more vulnerable. Invariably, you'll find that the currency will find its true value. What is the true value? it's a broad range of values.
Well, the CBN actually, yesterday, the governor actually said that there was a lot of arbitrage and round-tripping in the forex market, and it's going to come out with a couple of policies to ensure that all of this is actually checked. So are we going to...
No, listen, with all due respect to the governor of Senegal, that's a total waste of time. The reality is that a market, people round-trip and arbitrage because of, the arbitrage opportunities created by regulatory measures. Today, the central bank rate is 157, right? The interbank rate is 160, and then the parallel market is about 162. That is because of the intervention. If there was no intervention in terms of the CRR and all that, that thing will run away. When the FAC comes in, maybe next week or later this week.
No, it actually came in on Monday. The FAC has actually disbursed.
Yeah, okay.
When it's going to hit the market.
When it hits the market and all that, you will find that this exchange rate begins to actually depreciate again. However, but why worry about the exchange rate? First and foremost, the South African rand has depreciated by 17% this year. The rupee Indian rupee has gone down by 11%. The Indonesian rupee has gone down. So there's nothing sacrosanct about an exchange rate. The fear that there will be imported inflation that's fine. That's a natural fear. All you have to do is to manage it, but you cannot hold on to it like a golden rule that the exchange rate must be at a particular point, because that is what it is, that measure itself which creates the arbitrage opportunity. Because the foreign exchange market in Nigeria is what we call a price discriminating monopoly, where you are selling the same product in two markets at two different prices. The price of the dollar in the parallel market, the dollar in the interbank market, and the dollar in the official market is the same color and everything, but you're paying at a different price. So until that market becomes dissegmented, right? You have 3-4 segments. You have to dissegment it and harmonize it into one particular market. Then all of those arbitrary opportunities will disappear. Is there ever a free exchange rate? No, nowhere in the world. Central banks are paid to intervene to minimize the distortions and create some stability. What the central bank is trying to achieve is stability, but stability at what level? So
do we expect to see this stability in the next couple of months?
Yes, you'll see some stability at a high price, but the point is that the oil price is going to deplete. The oil price is going to come down slightly because of what's happening in Iran and what's happening in Syria. And if that price comes down below a particular level, you have to make some adjustments. Administrative controls and arbitrage management and all that is only what you call a band-aid. You're putting a plaster on a wound. You have to treat the wound. The reality is that at that point, Nigeria will have to make some adjustments. Whenever your revenues decline and your reserves deplete, you must make adjustments. The adjustments are at 3 levels. 1, monetary adjustments, which is interest rate and exchange rate management. 2nd, fiscal adjustment, which is you have to defer some of your spending. Federal government spending and state government spending, you actually insulate that and apply due process, defer some expenditure. Then finally, when the pressure becomes unbearable, you have what they call structural adjustments.
Now, the committee also noted that there was an increasing use of dollars domestically, especially by the political class. How can this be checked?
Well, money serves a purpose. 1, for transactions, 2, for speculation, and 3, for precaution. Money is a store of value. If there's a high inflation rate in a country, people will move their currency to another currency where the inflation rate in the US is 1.7, 1.6%. In Nigeria is 8.2%. But the interest rates in America is 0.5%, and while the interest rates in Nigeria are pretty high. So in terms of real interest rates, Nigeria is a better bet. However, if you want transparency and you're going to ask questions as where's the money coming from, then even the political class will have to now look for opaque ways to actually settle their transactions. And that's a political issue. But for an economist, we assume that all monies are fungible and that monies are there, and that illegal monies have a price to pay for it, and those are not for rational people. But since politics is a struggle for power, and political science is science of the study for power, then you have to understand that the money, people are fighting politically to get power, to become rich, while in other markets, people use money to get power, to alter society destiny, the destiny of society. So there is a conflict, but this is a stage of our development at this point in time. So that I would discount the dollarization of the economy, because many economies have dual currencies anyway.
Yeah, but it seems like there's more focus now on the dollar more than the Naira, and especially the bill, the change, and the parallel markets actually where they're taking these monies to go and do the kind of...
No, but listen, why don't you ask yourself, what is the cost? Why are they doing this? If the value of the currency was a true value, nobody would go around that. If you went to certain countries, if you go to Abidjan and you want to pay in dollars, people say go and change it to CFA franc because they know that the value of that currency is the true value and the market value. So why chase shadows? The reality is that deal with the true value of the currency. If the value of the currency is 157, then there will be no need to do that. But if the true value of the currency is actually 162 or 165, or they expect it to go to 170, then people are speculating in it and settling transactions in that currency which they know the value will be stored.
All right, let's hold on to that thought and take a quick break now on the program. Well, we're still talking about the decisions that actually came out from the CBN's Monetary Policy Committee meeting, which ended yesterday in Abuja. And I have here with me the Managing Director and Chief Executive Officer, Financial Derivatives Company Limited, Bismarck Rewani. Well, you can be part of this conversation. Just send your questions or comments to any of the addresses showing on your screen. We'll be right back.